The first step in our model building case study is to forecast revenues down to operating profit, or EBIT. We will stop at this point because after EBIT comes financing costs, which will depend in part on what we are forecasting for our operating assets. Earlier in this session, we talked about the inherent tension in model building between making your model realistic and keeping it simple and robust. The first principles approach, outlined here, identifies how you would go about modeling revenues if you need a high degree of detail and precision. The quick and dirty approach outlines how you can model revenues in a much more straightforward way, with the benefit that your model will be smaller as well as easier to follow and audit. For our case study, we're going to use the quick and dirty approach, using historic figures and trends to predict future growth. After forecasting revenues, we next want to forecast gross margins. Gross margins are usually forecast as a percent of revenues. Again, you can use historic figures or trends to quickly forecast future margins. However, you may need to consider a more detailed approach which considers the cost of inputs, as well as factors such as economies of scale and learning effects. This second approach will make your model more realistic, but also more complex and harder to follow. The next step is to forecast overhead costs. Forecasting overhead costs such as selling, general, and administration costs, or SG&A, is often done as a percent of revenues. Although these costs are fixed over the short term, over the longer term they are more variable. This allows us to link them to revenues. For forecasts over shorter periods like weeks or months, using revenues to help forecast SG&A may not be appropriate. Some models forecast gross and operating profit margins and leave SG&A as the balancing figure.